We're going to take a look at the proper asset allocation by age into stocks, bonds, and fixed income investments, and most importantly, what not to do. Stay tuned for more. Thank you for watching. This is Richard with Wisdom Investor. We're going to take a look at asset allocation here today. We're going to take a look at how a person should be allocated in their investments, whether they're young, middle-aged, or in retirement or near retirement. And we're going to look at our current stock market timing conditions and see what type of allocations we're going to be adjusting to here going forward. So let's get started here. Stay tuned for the entire episode also. We have some good information here to share. So let's take a look at the first thing we need to think about. Whether we're young or old, we might be in our 50s and just starting our investing. We could be in our 20s and 30s and starting our investing. But the first thing you want to do is get a 6 months emergency fund set up. That's the first thing you want to do. Once you get your emergency fund set up, start saving some money for a down payment for real estate. That would be the second most important thing to do. And if you're working, invest in a 401k. Participate in your 401k plan at your work. Many times, most of the companies will also contribute an extra amount, which is basically free money. So those are the first three things that a person would want to do when developing their asset allocation. Now, one of the most important things not to do when developing your investing plan or your asset allocation is to just jump into something that's a fad. Here's on July 13th, 2020, 10,000 day traders an hour are buying Tesla shares. It goes on to say here almost 40,000 Robinhood accounts added shares of the automaker during a single 4-hour span on Monday, according to website robintrack.net. The one-day return may not have returned out so well. Tesla was up as much as 16% at one point before pairing gains through the day and finishing 3% lower. Let's take a look at the Tesla stock here. So the Tesla stock has been moving higher. So what happens is people start getting excited about a stock when they hear about it rising quickly in the market. So what happens is everybody starts to jump in at the highs, and guess what happens at the highs? The stock starts to sell off, and then that gives you a negative impression. It gives you a negative experience in the stock market, and you may not ever want to invest again because you'll be going around saying, I lost this money in Tesla. Now, I'm not saying Tesla stock is a bad stock. It's made a lot of people a lot of money. There's no doubt about it. But what happens is people get excited about investing at the highs. What we want to talk about here is investing the right amount of money and building a portfolio that will grow for your future. So let's talk about proper asset allocation by age. Here's a general rule here. If you're 30 years old, 90% stocks, 10% bonds or fixed income. If you're 40, 80% stocks, 20% into bonds or fixed income. So keep in mind, from 25, say, to 40, you can be a little bit more aggressive. Now, keep in mind, when we talk about at that age being a little bit more aggressive, everybody doesn't have a risk tolerance of being aggressive. And of course, not everybody wants to be conservative. So even though it says you want to be 80% invested as a young investor, you also have to look at your own personality type, your own risk level type. Now, a person that's, say, 50 years old, 70% stocks, 30% bonds or fixed income. When you get into your 60s and 65, you're going to start paring that down. 60% stocks, 40% bonds and fixed income. So generally speaking, again, it's going to depend on your particular risk level. As we get 55, 60 years old, we're going to have less money in the stock market. Now, here's the conundrum. In today's world, it's hard to make any money in a fixed income investment. It almost forces us to be invested in the stock market. So you can be invested in the stock market, but you can take a more conservative approach. Let's take a look at a graph here that gives us some good information here. When you're 20s, 30s, and 40s, 70% stocks, 30% fixed income. When you're nearing retirement, the 60-40 strategy, 60% stocks, 40% fixed income. And then when you're in retirement, the 50-50 model would work. Keep in mind, as we said a moment ago, in our basic plan, we want to make sure we have our 6 months emergency set up, that we cover 6 months of your living expenses. Hopefully by the time you're, say, in your 50s, you've already purchased some real estate. But if you're in your 20s and 30s, start saving for real estate and also participate in that 401k plan. Now, depending on your risk and how you invest, what would a person expect to generate as far as a return on your investments? If you're more conservative, the average return is about 5.94%. If you're balanced, say 50-50, you could expect almost an 8% return, and the most aggressive person would be about a 10.13% return. So let's look at a asset mix here. Again, the most conservative, maybe you just don't want to be in the stock market at all. You could have 100% in fixed income. That is possible. A conservative investor might only have 50% in the stock market and the rest broken up into fixed income. A balanced investor could also be a 50-50 approach. And then your most aggressive investor may have anywhere between 70 to 100% invested in the stock market. Okay, what is our current stock market timing situation like right now? So we have earnings season coming upon us here right away. We're going to start getting earnings from various companies. We're going to find out if they're going to increase their dividends or lower their dividends, or is the stock price going to increase. Now here's the S&P 500. This goes back for the last couple of years, but here we are right now. Of course, here was the coronavirus dip in the markets. So now the companies have had a chance to operate under the coronavirus conditions. We're going to find out if their profits are there or not. We're going to find out if they're going to be increasing dividends. So what we're going to be doing is evaluating the market here while we get these next round of earnings so we can make adjustments to our portfolio. Now here's my current situation that I want to do. I'm going to have 50% of my core, which would be blue chip stocks, would be ETF funds, would be dividend paying stocks, is 50% of my core. I myself, I'm in my 60s now, so I'm going to invest differently than I would if I was in my 20s or 30s. If I was in my 20s or 30s, again, I might have my investment capital as high as 70 to 80%, or it could even be 100%. Over here, we're going to have 40% in some type of income generating investments. That can vary from bonds to money market funds, high dividend paying funds. And over here, the 10% is a strategy of swing trading. In other words, as the market moves up and down, I'm going to either be in the market or out of the market. So a typical swing trade would be, as this market is moving up, X amount of funds would be invested in the market as it's going up. And then when the market goes down, I would want to be out of the market. Now, in general, on my core, I'm in the market when it's either flat or moving up. If we get into a situation where the market is starting to drop massively, I take my profits in that situation. Now, other folks want to be a buy and hold investor, and they're going to be in the market at all times. There is a certain, and the buy and hold strategy can be effective. There's no doubt about it. What is really important, though, in the buy and hold is when you're going to need the money. If you're getting ready to buy some real estate, you may want to have your money in a more conservative investment so that you don't take a chance that it goes down. So a lot of that's age dependent and when you're going to need the money. So I want to thank you for watching.